Welcome back, everybody. Thank you so much for joining us yet again on SF Live. My name is Kai Hoffman. I'm the @JR Mining Guy on Twitter and the CEO of the Soar Financial Group. If this is the first video you're watching here on the channel in January, please let me say Happy New Year. I know we have quite a few subscribers that watch every single video, so apologies for repeating myself, but health and wealth to you, 2023. All the best, of course, and make sure to, invest accordingly and properly. And again, thank you so much for your time. And today we're sort of wrapping up our Outlook or a recap and Outlook series here on SF Live. We had some fantastic guests on, so make sure to check out our videos. We had Doomberg on, Rick Rule, Alistair McLeod, Lobo Tigre, just to name a few. And we saved the best for last, right? It is Brien Lundin. He is the publisher of the Gold newsletter and a good friend of the show. We've had him on the program a good number of times. Brien, it's good to see you again. Happy New Year, and thanks for making the time.
Thank you, Kai, for having me on. As you read through that list of dignitaries and celebrities that I'm following up on, I started to get imposter syndrome. So thank you.
Now you know how I feel just sitting here. Okay.
Yeah. Well, true. That makes me feel a lot better about it. Thank you.
Exactly. It should. No, Brien, really appreciate your time. And it is early January, and I think we could still recap 2022 a little bit. Last we spoke was mid-October at your fantastic conference there in New Orleans, the New Orleans Investment Conference. And one of the topics was, of course, the Fed, interest rates, and of course, interest payments. Can you recap sort of the last 8 to 10 weeks of the year for us? What has changed? Because I think it felt like there was a bit of a momentum change in the markets.
Yeah, there was. Shortly after we talked, maybe people watched our interview, maybe the movers and shakers in the market watched that interview and tried to get ahead of the game. But when we talked, gold was, at the New Orleans conference, gold was actually experiencing some pretty significant declines, but everybody seemed to be kind of accepting of that fact and comfortable that in the end, over the longer term, that we were going to have much higher gold prices, and those levels represented really bargain levels that were going to be turned around eventually, and probably by the end of the year to start a more of a seasonal rally. Now, we talked at the time about the rising cost of servicing the federal debt. I don't remember if the latest numbers had come out then. I don't think they did. I think shortly after we talked, they came out. And at the time that we talked, they were about $600 billion a year annual run rate on interest on the federal debt. The next update came out shortly thereafter, and it's at $736 billion. And I was predicting at the time that it would surely be over $1 trillion very shortly because of simple math. At the time we were talking about a 10-year yield, treasury yield around 4% or so. It's dropped a bit since then. But I had done some work to calculate the actual interest costs on the federal debt over decades, and it seemed to come in around kind of like a smooth 10-year yield rate. So if you're talking about 3.5% to 4% on a $31 trillion debt, you're talking about $1 trillion a year. Well, now, as you mentioned, they're talking about 5% on the Fed funds rate, which would mean the 10 years is going to start hovering around that at some point. So roughly speaking, 5% on the federal debt is $1.5 trillion a year. So, the government has once again made me seem like a Pollyanna and an optimist. And they're spending more and more quickly than even I could have guessed. So that factor really has not entered the mainstream as I would have expected it to yet. I haven't heard anyone in the mainstream media talk about that huge cost of servicing the debt yet they keep talking about 5% now on the federal funds rate, and nobody goes to the next step and makes the next logical conclusion. What does that mean for debt service costs? When we were talking, we were also going into or getting ready to enter a seasonally positive market or period for the metals. Typically, gold starts rising or bottoms somewhere in mid-December. Doesn't always work out that way, but the majority of the time, it actually bottoms sometime around mid-December and starts a rally that begins or carries through into the new year. Gold actually bottomed right around early November and started that rally early this time around. And up until today, when we're talking, when gold's down about $25 or so, it has had a pretty uninterrupted move higher. And nobody's really recognized that fact. There's still a lot of doom and gloom in the junior mining space and among gold bugs. And nobody's really noticed that we put close to $200 behind us in the gold price over that period. And it looks pretty good going forward because the market, or the gold market at least, is beginning to sniff out the inevitable end of the Fed rate hike cycle. And all it will take at this point, in my view, is the Fed to pause, not pivot and start cutting rates, but just stop to really launch a kind of a massive move higher in the metals.
No, absolutely. I'm here with you, and we'll get into the details of like why we're in a bull market rally. It feels like, or at least in an uptrend on the gold, but also on the stock side. You've been following the Fed obviously quite closely. Have you noticed a bit of a change in language? You know, it's like I read the FOMC minutes yesterday, and they're really worried about a recession as well. So they're quite cautious. Like, what are you hearing, and what are you making of this?
Yeah, it seems likely that a recession is on the way. I mean, you have the very steep inversion of the 2-10 Treasury yields, which has over the past 40 years or so has never failed to predict a recession. You have the a collapse in the leading economic indicators, which over that same time period has never failed to predict a recession. So two of the most reliable indicators are pointing toward a recession. The thing that most of the mainstream economists and Keynesians are pointing to is the relatively strong jobs market. And now that argues against a recession, but my argument now is not so much that we're having a down jobs market. It's not really a lack of jobs. It's a lack of filled jobs. It's a lack, not of jobs, but a lack of employees that is really holding the economy back, which is unusual and maybe the first ever that we've been in this situation. People just don't want to work for whatever reasons. They've been trained, really, like Pavlov's dog, to sit back and not go to work, and they kind of got used to it over COVID. So for whatever reasons, there's a lot of unfilled job openings out there, and a lot of people sitting on their couches. So that is really holding the economy back. All the technical indicators are pointing toward recession, and that's why the Fed has started talking about, or very obviously talked about, slowing down the pace of rate hikes, not pausing the rate hikes yet, but slowing down the pace. And that alone was enough to really spur a rebound in all of the risk markets, stocks, bonds, and commodities.
No, jobless report, as we're recording this on January 5th, initial jobless claims came down below expectations, actually at 204,000. So sort of goes with your theories, like there's enough jobs around. And it is one of the indicators that the Fed is looking for is the unemployment rate and forecast. It's coming out tomorrow. So we're recording this, 3.7% is forecast. Yeah. So unless something breaks, I don't see anything changing or the Fed pivoting, quite honest. And they seem to be happy with the job they're doing because the inflation rate is coming down as well. They seem to be on the right trajectory, right?
The inflation rate's coming down because of goods prices coming down, and that was the part of the supply constraints, et cetera. And the effect of having ultra loose monetary policy in the teeth of really supply chain disruptions and the like. I mean, anybody would have known that would spark inflation, but apparently it didn't fit the econometric models that they work on. So, they didn't see it coming, even though everybody else did. Now, that part of the goods prices are coming down. But we have the services inflation, which has always been relatively high for many years and looks to remain even stickier now, in part because we're just starting to see the wage cost push inflation coming in. That's what really worries the Fed. and and I think that's what really has them still remaining somewhat steadfast in their rate hikes. I think they're going to have to reevaluate things when we actually do get that recession, when there is some talk in Washington about the federal debt and the cost of servicing the federal debt. And frankly, when something breaks in the financial plumbing, the bond market, in other words, because of these rate hikes, we haven't seen that happen yet, but we've seen that precipitate every other financial crisis out there. It's kind of conspicuous by its absence in this cycle that we haven't seen a Lehman Brothers moment. Maybe the crypto thing, took some air out of the speculative markets, but I don't think that was enough to affect the real financial plumbing, the bond market. So that's kind of looming on the horizon as well.
It feels like it was, for lack of a term, fringe money. It was the money that the government gave out to that ended up in the FTX scandal. It wasn't core money. I don't know, for lack of a better term, like
it's money that went to money heaven, so it was deflationary to some extent, but a lot of that money was already spent, on Bahamian homes and the like, and luxury automobiles and yachts and things like that. But yeah, there would be some deflationary effects of all of that. But that's not the big thing that we're looking at that's potentially on the horizon.
Very interesting. You brought up the hourly earnings and the wage increases, and I looked that number up actually before our conversation, and because the Fed keeps saying, well, we want to bring inflation back to 2%, and I'm looking at it. December numbers are coming out tomorrow. We're looking at 5.1% in November. Forecast for December is also 5% wage increase year over year. So how are you going to get to 2%?
Well, you won't. It's a ridiculous number anyway. It's an arbitrary tax on people. When they talk about inflation of 2%, they should be honest and say, well, we want to increase your cost of living by 2% at least, if not more. But aside from that issue, they're probably not going to get it down to around 4%. And that's not me saying that. The people I really respect in the markets that are smarter than me on this, that really follow it, are looking at inflation settling around 4%. They may be optimistic and maybe around 5%, but it will still be far above the Fed's target rate. One of the scenarios that I look at that I'm not predicting this, but I think it's very possible, is that the Fed can only get inflation down to 4 or 5%, still double or more their target rate, not hitting their goals, yet are forced to pause or pivot and basically give up the fight against inflation, with inflation still remaining well above their target levels. That is a sign to the markets that the Fed has given up and is essentially impotent to fight inflation because of all these other issues: the market's addiction to easy money, the size of the federal debt and the cost of servicing the federal debt, the fragility of the financial plumbing system in the bond market, which has also become used to ultra low rates. So all of that combining, forcing the Fed to turn back with the inflation rate still high, that for the first time since prior to 2008 would be an investing environment that is bullish, not for stocks and bonds, because even though the Fed is returning to some easier policy, you still have high inflation eating away at returns. So it is not bullish, or not that bullish, for stocks and bonds, but conversely, it would be very bullish for precious metals and commodities. The end result of that would be you would see some allocation from these other huge asset classes, stocks and bonds, toward precious metals. And as we know, it wouldn't take much of a shift in allocations from those huge markets to the relatively tiny precious metals markets to really just send them ballooning up. That's a very possible scenario, I think, is on the horizon, because I don't think the Fed can get inflation below, say, 4% or so.
Yeah, absolutely. And it's usually the stocks that sort of give away and forecast a bit what is going on in the markets. Like the GDXJ is up. They're both up over 40% since the end of September. Nobody's talking about it, right? So
No, nobody's talking about it. And in fact, they're talking precisely the opposite. Before we came on, I brought up gold versus GDX, gold versus GDXJ, brought up the correlations. And the correlations have been very tight since really early November. Since the rally started in gold in early November, the metal stocks have followed along in lockstep. And maybe they haven't offered as much leverage as we would have liked in a real raging bull market environment, but they've certainly responded to the move and moved higher. And if you ask the consensus view of our friends in the junior mining industry and in other gold bulls and gold bugs, they would say that the stocks really have not responded at all and not followed gold higher, if they even recognize that gold has added about $200 over that time span. So it's remarkable that, you know, as I quoted Don Cox in a tweet yesterday, the markets are loved least by those who know them best, and we're so mired in this market and you know, following it day to day and caught in these emotional swings that we find it difficult to take a step backward and look at the charts and recognize what's going on. You know, we just get so depressed. But by the same token, when the market's at a high and in peaking, we tend to be so emotionally invested that we don't recognize that the peak is there as well. And that's the worst part, is that the damn generalists, you know, the chart watchers, the you know, unemotional technicians tend to make all the money in our markets, and we don't. So
No, absolutely. I was talking to our good friend Rick Rule at the end of December here, and he mentioned he expects another 6 months, so let's say early June perhaps, where we have an opportunity to still get cheap financings, get a warrant attached, because mining companies will still be under pressure financing. Like the financing market won't be as, you know, liquid as it used to be, and he expects to pick up some great opportunities. That sort of goes against what you're saying. Like it shouldn't be that way. But as you said, like the market insiders, people are too close to the, you know, forest before the trees, or whatever it's called, like that saying, or trees before the forest. I don't know. You know that saying probably better
yeah,
than me, but
yeah.
we're so close to it. Maybe we don't see it. Like we want it to be positive, but it's not. Like what is dictating that negative sentiment? Like why are we so negative?
Well, we've been you know, we're like beaten dogs, you know, we're still, whenever we get our head up, we're just flinching, we're expecting the market to beat us about the head once more. You know, I put out that tweet how yesterday about how gold bugs are so pessimistic on the market, and gold has made this great rally and nobody's really recognizing it. And somebody responded, yeah, it's a rally, but just wait for the next beatdown. And I was like, is that supposed to be a counter argument? What I said, or what? You're just proving my point. Yeah, that's you know, we justifiably, we ought to be a bit pessimistic, a bit cynical, at least, because we feel like there's other forces out there that, you know, logically gold should be far higher than it is today, and for a lot of reasons, and I think valid reasons. You know, the saying is, I need new conspiracy theories because all mine have been proven true. But there's a lot of reasons, there's a lot of really valid views out there that the markets have been manipulated somewhat against investors. So it contributes to this pessimistic attitude. Yeah, if Rick thinks we'll still have some opportunities, he's the smartest guy out there for timing the cyclicality of these markets. He's the ultimate predator investor in the resource markets. So if he thinks he's going to get some good cheap financing opportunities, he very likely will. Now, that said, good projects, good companies can still raise money right now. It's not a vast wasteland in the financing area. There are financings being opened and closed pretty rapidly out there, but it's not like the good old days of, you know, the summer of 20 or kind of a thing.
No, it's like 20. It's like, maybe if I can jump in here, because we've run Orange Inc. as well, and we just looked at the numbers for 2022. It wasn't as bad as you might think it was, right?
Yeah.
We've raised close to $4 billion Canadian, like in the Canadian junior markets. Like that's a great number, because 2015 we barely raised 2.5 billion. Yes, last year, 2021, sorry, like the year before last, so 2021 it was 6.4 billion. Of course, it was higher.
Yeah.
but it definitely didn't feel like $4 billion last year. Because when I looked at the numbers, I was like, really? Right. So as
Yeah,
you said,
I would agree. I wonder if there were some big chunks of that taken down by, more generalist funds and the like for or project specific kind of things.
like we don't track financings over $100 million and no debt
Oh,
financing. So
okay.
that's pure equity for the juniors. Like market cap is below
Hmm.
$1.5 billion. So when I looked at that, I was like, huh, it felt way worse than that. It did feel
Yeah,
like 2015, right? So I was surprised because I don't look at the numbers on a daily basis, but I was like, okay,
the
let's spend that
sentiment
money
would not.
wisely.
Yeah, the sentiment would not indicate that. Would not support that.
No, but the numbers tell that game. You read the Gold newsletter, Brian, right? So since we brought up stocks, let's talk about. I don't want we don't have to talk specific stocks, but
Hmm.
what you brought out a January edition just now, January 4th, I think was the last one. Did you sort of restructure the portfolio now a little bit? Are you looking at producers, developers, explorers? What's your weighting these days?
Yeah, I can talk about themes. It's hard for me to follow themes. When uh, I tend to get caught up in some exciting exploration stories and the like, that run counter to themes that I might pontificate about here and there. Generally speaking, if you're looking at a longer term or consistent rally upwards in the metals prices, you want to get those companies that have big established resources that are easily valued at this higher metals prices. It's generally the first to move. So that's one good theme. But beyond that, there are a lot of good exploration and development stories out there where you can be confident that companies are building resources that are undervalued and will continue to have exploration success. I can talk about a few names that I started buying. I guess shortly after we talked in October-November timeframe, I was buying Vizsla Silver. I was buying Fireweed Metals and Scotty Resources. Very familiar with all three of those stories. Really had confidence that they were at low levels and were going to grow. We've since recommended Exploits Discovery because they had a great land claim that they got. We recommended that in the newsletter or in my alert service, and it about doubled in value shortly thereafter. I have to take another look at it where it is now, but I think it has great exploration potential even at current levels. But that's a sign of what I'm talking about. Big resources at still bargain levels. That's a good area to look at. But there are some really enticing exploration plays out there that people can find as well that offer the real 10-bagger potential.
Yeah, no, absolutely. Full disclaimer: shareholders of Fireweed as well here. So happy to be as well. Looking good, looking good. Brian, jumping around just a little bit, I want to change gears. Like you obviously organized the New Orleans Investment Conference as well. It is in October, so still ways away. It just happened. It feels like.
Yeah.
If you were to predict a theme, and that's really forward-looking, like it feels like we can't predict it because the markets are so volatile. If you were to pretend there was a theme for this conference, like one buzzword, would it still be inflation like it was in 2022, or do you think it'll change?
Well, I think it's the Fed. Everything is the Fed. Everything's driven by central bank monetary liquidity, and has been, over the 40-year bull market in bonds since Volcker quashed inflation and started an ever lowering of interest rates 40 years ago. The markets have been increasingly addicted, increasingly driven by central bank liquidity. That went into overdrive post 2008. And now every day on a moment by moment, minute by minute basis, every asset market is priced by Wall Street traders based on their reading of the tea leaves for Fed policy. That's the only thing that matters. Now, inflation obviously drives Fed policy, but still inflation is interpreted as to how it will influence Fed policy. And anything that points toward a more dovish stance or less hawkish stance for the Fed means every asset market is bought to some degree. Anything that points toward a more hawkish or less dovish stance by the Fed means that all asset markets are sold to some degree. That's why all the correlations, stocks, bonds, commodities, precious metals, have trended toward one since 2008. That said, over the past couple of months, gold has shown some signs of breaking its linkage with at least the equity market. The correlation, rolling 20-day correlation with, say, the S&P and gold, which was once hovering close to 1, has dipped into the negative zone, about negative 0.25 now, meaning an inverse correlation. And that's happened only briefly and only a couple of times since the Fed started to raise rates in last March. But now, for the first time, it's happening for a good reason, and that gold has been trending higher while the stock market has been trending flat or lower. So it's a good indication right now for gold.
Interesting. Lei, I'm curious now, thinking forward, probably too far ahead, but do you think the Fed will be lowering rates by October? That should create some buzz on the floor.
Yeah, I think that, they don't have to. What would precipitate them lowering rates would be some type of a financial hiccup. I think I would place that at about a 70% chance over the next year that you're going to have either a hiccup or crisis, something above hiccup level happening in the markets that will prompt them to start cutting rates. I think you're looking at close to 100% certainty that by October they have ceased raising rates, they have paused, and I would say about 70% or more likelihood that they have pivoted by that point.
Interesting. Yeah, I'm curious how that all plays out. It feels like almost impossible to predict. There's so many macro events happening left, right, and center. And I just spoke with Alistair McLeod, and
Yeah,
fantastic, very, very smart guy.
brilliant.
And we talked about the petro yuan, right? Because we talk a lot of US focused, very US centric, but
Mhm.
he's sort of opened my mind to say, okay, what's happening? Saudi Arabia, the attack on the US dollar from the outside, what the Fed is actually doing is not really relevant, right? To a degree. Like, of course, the US is still the main financial market in the world. It's still driving a lot, but there's a lot happening on the side that might interrupt what we're just talking about. And I almost felt foolish having those Fed conversations the whole time based on the conversations I had with him. So it was really, really interesting, right? So that's sort
Yeah,
of
the gold price, gold's at record highs in every currency but the dollar. If you look back in the early 2000s, the situation was reversed. Back then, gold was surging to new records only in the dollar and not in all the other currencies. And when the other currencies joined in around 2003, then it really took off. This is a bit of the reverse. When we start getting those highs in the dollar and joins the other currencies, I think that's when this multi-year secular bull market in gold continues. But yeah, it's a great big world out there. And while Wall Street trading sets the prices on a daily basis for just about everything, at some point, control is loosened and, and other markets can take control. I'm not a big believer that the dollar's role as the global reserve currency is in any danger in the near term, because the U.S. Has lousy rule of law, but still better rule of law than any other regime out there. So I think that's the real key, not the aircraft carriers, but the rule of law that those carriers enforce. That said, China's doing some interesting things with its gold reserves. And if it is able to objectively and independently establish a reserve currency that's attached to gold, and it'll have a leg up on anything else out there. That may be and is very likely part of their long-term plans.
interesting. Well, we're on the gold bug side, right? So I think we're on the right side there as well.
Yeah.
Hopefully, at least we're hedged. At least we're hedged. So
Yeah.
fantastic. Brian, one last question. Do you think silver will close the year again higher than gold or on a percentage basis?
Yeah, I think so, because gold is being moved now for monetary reasons, not these short-lived geopolitical issues, but because of concern over the future purchasing power of whatever the dominant currency is at the time, which is, of course, the dollar. So gold's moving higher for monetary reasons, monetary concerns, and in every previous instance that has happened, silver has outperformed gold. I don't see any reason why that would suddenly cease. There are a lot of factors actually working for gold. There are a lot of concerns about gold supplies and backings of the paper gold futures markets right now. So, yeah, I think it will. I think if you like gold, you should love silver.
Perfect. That might be the YouTube title for the video. So
There you go.
I might use that. Fantastic.
Any more work I can do for you, Kai?
I might hire you as my editor and producer. I desperately need help here. So
You too, huh? You too.
oh my goodness. Tell me about it. Brien, phenomenal conversation. I really, really appreciate it. Where can we find more of you? The goldnewsletter.com? Goldnewsletter.com, I think it is.
Yeah, simply goldnewsletter.com and neworleansconference.com and Brien_Lundin on Twitter.
Fantastic. Do you have the date for the October for the conference yet?
Yeah, November 1st through 4th this year.
Okay, right after Halloween.
Right after Halloween, so you can come in for Halloween, tour the French Quarter on Halloween, and show up.
I was going to say I might miss the first couple days of the event.
Yeah, come early.
Awesome. No, that's great.
Late.
Fantastic. I might have to book a hotel. I have to admit, like, it was one of my favorite conferences of the year. I got so much out of it, so can't wait. Thank you so much, Brien.
We enjoyed that you're able to get through the border this time and visit us. So
exactly, like that was, yeah. Let's see. Always a challenge. Although I got global entry now, I should be fine.
There you go.
Perfect. Brien, thank you so much for your time. Happy New Year again. Health and wealth. I love that saying. I stole it from Lobo Tigre, so I'm going to use that, and we'll bring you back on soon. Thank you so much.
Thanks, Kai. Always a pleasure.
Fantastic. Everybody else, thank you so much for tuning in. This sort of is the end of our recap and outlook series here on SF Live. We will be continuing, of course, with continuous market commentary. We'll bring on lots of fantastic guests over the coming months. We'll be heading to the Vancouver Resource Investment Conference. We'll have interviews in our studio in person in Vancouver. Really looking forward to that. Haven't done in-person interviews since Brien's conference, actually. No, I've been at Minds Money, but Brien's conference definitely had 17 interviews there. It was exhausting. It was fantastic. Really enjoyed it. And we hope you get something out of it. That's why we're doing it. We hope it's educational. We hope it helps you make some better financial decisions looking at the markets. And make sure to follow us. Hit that like and subscribe button. I know roughly 85% of you to 90% are not subscribed to this channel yet that are watching. So let's change that. Really appreciate it. And leave a comment. What do you think is going to happen over the next 12 months? I know it's very difficult to predict, but you might have an inkling as well. Let us know in the comments. We're happy to comment on it as well. And we'll be back with lots more. Thank you so much. And health and wealth to everybody.